to any of the homework, started doing any of that over break. You probably noticed there's a lot to figuring out income tax withholding. We did start a little bit with a preview before we left for break. So hopefully if you did do some homework, that was helpful to you, but we'll do a little bit of refresher on that today as well, just because it has been a while since we talked about that. So that'll take us through, well, I guess not quite through the end of, so today, Thursday, and then next Tuesday, we'll cover chapter 4. Homework for chapter 4 isn't due until the 4th. So you've got time to work on that. So there is a little bit of overlap here. You can see in this particular, in our schedule now between what we'll start on chapter 5 before that chapter 4 homework is due. Okay. So, but you do have time to get that stuff done. Moving right along, so we get into April, we've got our chapter 4 assessment. So chapter 5, where we will talk about unemployment taxes, which will take, I've got 4 class periods available for that. If we need a little bit more time for chapter 4, it's okay if we bleed into the chapter 5 time, our first period for chapter 5 a little bit too, because I think chapter 4 is probably a little bit more intense than chapter 5. And then our last chapter, chapter 6, we are going to work on integrating all of the information that we've learned how to generate into the accounting system. So obviously payroll is a big expense for companies, and all of that information has to be then part of the financial statements. And so we're going to look at the journal entries that are required for that. Now, if you're working in the payroll department and you're not part of the accounting department, chances are you're not really going to be involved in those journal entries necessarily, but oftentimes in small and mid-sized companies, the payroll department and the accounting department kind of share functions. So it as well could be part of the duties of the payroll clerk. So we're going to look at how we integrate that information into the financial statement. So you'll have to, if you've taken accounting, financial accounting, or if you're taking it now, that'll be great. If you haven't taken financial accounting, you haven't had any background in debits and credits and all of that stuff, that last chapter may take a little bit of work for you. I think all of you, though, were at least, you've taken PRIN 1 or Intro to Accounting, or you're currently taking them. So if that's the case, then you should be good. You should be golden there. And then we're going to get to the end of the semester, 6 more weeks, I think it is, that we have, where we'll do this comprehensive assessment. Will be on the 27th of April. That is in class. If you can't make it in class, then we'll have to schedule a time for you to take it at a testing center. It is a proctored exam, so we gotta do that. And then the final exam, though, as I had mentioned, is going to be a take-home exam, and you'll be able to use your materials for it. It'll cover everything, though. Okay. So just kind of a little summary, and we'll talk more about those things when we get closer to that time. I know you just finished that midterm exam, so I don't talk about the final yet, but I just wanted to kind of give you a little preview there. Questions before we get started? No? All right, did anybody get a chance to look at the homework or look at chapter 4 over spring break? If you didn't, I get it. Kind of a great week to procrastinate. Yeah, and go ahead. I don't know if you have your microphone on or not. I can't hear you.
Yeah, I say I'm trying to do some homework for spring break. May I have one question? Maybe after the call, you can help me to figure out.
Okay. Yeah, absolutely. And maybe is it, so it's a chapter 4 question? That might be a good one. That might be a good one then we can go through as a group. I'll try and give us a few minutes at the end here today, because I'm sure if you have a question, Others will eventually have a question on it.
Yeah.
Okay.
Thank you.
Okay. Yeah. Excellent. Okay. Let's see here. All right. So let's get back to talking about federal income tax withholding. So a couple of things I kind of skipped over because I wanted to give you an introduction to how the withholding is well calculated or looked up on the tables. But I kind of skipped over some of the early parts of this chapter in order to do that. So I do want to go back and cover a few of those points. The things that I really want to talk about here, you can read the withholding laws and all that stuff. I'm not going to cover that. Most of the rules with regard to whether or not wages are taxable for federal income tax withholding purposes are the same as they are for Social Security and Medicare tax purposes for the most part. So we already went through all of that in chapter 3, so I don't think we really need to rehash all of that. Just understanding, for the most part, wages, salaries, vacation, all of the same kinds of stuff. That stuff looks very familiar to what we were talking about in chapter 3. Taxable fringe benefits as well. There are certain benefits that are deemed taxable to the employee, and there are certain benefits that the employee receives that are not taxable. And one of the differences between benefits that, well, we have two separate categories of benefits. We've got those benefits that are paid for by the employer. So the employer provides those benefits and they are a form of compensation for the employee. So these would be things like employer portion of retirement benefits. So if you work for a company that has a retirement plan and the employer helps to put money into that retirement plan, that is an employer provided benefit. That would be an example of that type of benefit. But then we also have these benefits that are paid for by the employee, but they're taken out of the paycheck. So the employee never gets their hands on that money in order to make the payment themselves. The employer sort of acts as the intermediary to collect that money and send it off to whatever the benefit company is. So an example of that might be health insurance. So if the employee pays toward health insurance, then that would be a benefit that the employee is paying. The employer is gathering the funds when the employee is paid, and they are the ones sending the funds directly to the insurance company. So again, employer provided benefits versus employee paid benefits. Now, some of those employer provided benefits are taxable. So, and you've got, in fact, I think you've got some problems in your homework that go through some of those employer provided benefits that are taxable. Gym memberships, for example. If the employer pays for you to join a gym, or maybe they reimburse you for a monthly gym membership, that sort of thing, that is considered taxable income. That is, it's an amount that the employer pays. It's instead of you receiving cash, you're receiving this benefit, and it's taxable to the employee, right? So the employee has to, even though they didn't get the cash for it, they still have to pay the tax on that particular benefit. Then we have benefits that are not taxable. The example of the retirement contribution. So even if the employer pays toward retirement, the retirement plan for the employee, that contribution is not considered taxable income to the employee. Now, at the point that they retire and start drawing the funds out, then it will become taxable to them. But at the point that the employer is contributing to it, it is not taxable. So we've got these employer provided benefits. Some of them are taxable, some of them are not taxable, right? So we've got and these are the fringe benefits. Some of them are taxable, and some of them are not taxable. Okay? Two types. So these are the ones that are where the employer pays it. Then we've got benefits that are paid by the employee, but those benefits are being paid through paycheck withholding, right? So these are employee paid benefits. And again, we have two types of employee paid benefits. So we've got those that are post-tax and those that are pre-tax. All right, so this is essentially a subtraction from pay, okay? This is an addition to pay. There's still benefits, just two different types of benefits. But again, some of them have tax benefits associated with them, some of them do not. Those benefits that are taxable, so those benefits that are provided by the employer to the employee and are taxable, the value of those benefits is going to be added to the employee's taxable income. So, for example, if we have, let's see if you guys can all see this here. If we have a wage of $1,000, real simple, $1,000, and then we have some sort of employer-provided fringe benefit. Let's say it's a car. You get an employer-provided car, and the value of that car is $200 per paycheck. It would be whatever the fair market value is. I think your textbook does go through vehicles a little bit here, employer-provided vehicles. The full taxable amount would be $1,200. Even though the employee didn't receive $200, they just received, what they received was the benefit of being able to use the car personally in their own personal, for going to the grocery store, picking up their kids, that sort of thing. They've got a personal use of the car. So the value of that is going to be added to the wages. And then this is what we're going to calculate the tax. We're going to use this number to calculate the tax, not the cash that was received, but the full amount of the full taxable amount. Okay, so this is when, this is this situation here, a taxable amount. Now, if we have other benefits, like that 401k, let's say that the employer paid contribution to a 401k was $100 every paycheck. Well, that is not going to be included in this $1,200 because that is a non-taxable fringe benefit. It's not taxable to the employee. Again, both of these are additions to pay. It's a value added for the employee, right? They're getting additional benefits over and above just the cash that they're receiving. Some of those benefits are taxable, some of them are not taxable. So when we have a problem that includes taxable fringe benefits, we have to add it to the wages that were received before we can calculate what the tax is on that. Does that make sense? Okay, so that's employer provided fringe benefits. Employee paid benefits, kind of the same concept, but now we're talking about subtractions. These are amounts that the employee is paying out of their paycheck. So if we're talking about a post-tax deduction, that would be something like a garnishment. Child support would be an example of a post-tax deduction. That would be an amount. Actually, I'm going to go with the pre-tax first. Post-tax, let's just say we do have a child support. And the employer is taking $200 out of that $1,000 paycheck to go toward child support. Well, the employee does not get the benefit of that reducing their taxes. They're still going to be taxed on the full $1,000, even though they're only getting $800, because child support is not a tax deductible payment. So this is an example of a post-tax deduction or benefit. Well, it's not really a benefit, it's more of a deduction. Pre-tax would be something like health insurance. So if they pay $250 for health insurance, as long as it's part of a cafeteria plan, we talked about those back in chapter 3. Now, the taxable amount is $750. This is what we're going to calculate the tax on. You can remember these by the prefixes. If it's pre-tax, pre means before tax, I've got to subtract it before I figure out the tax. If it's post-tax, post meaning after, that means that I'm going to subtract it after I figured out the tax. So in this example, we would have, even though the employee, so the taxes are going to be based on this, the $750, taxes would be subtracted, and then at the end, an additional $200 is going to be subtracted for the child support. But that child support doesn't give them any tax benefit. Does that make sense? So keeping these straight is important. And you're going to have a lot of problems that involve these particular, these types of benefits and deciding, okay, are they pre-tax or post-tax? How is it going to be treated? But just remember, so this adds to the tax, and these add to the wages, these subtract from the wages. Okay? Questions? Now, there's one particular and all of these are pretty much the same, whether we're talking about federal income taxes or Social Security and Medicare taxes. So we have pre-tax deductions and post-tax deductions for Social Security and Medicare tax purposes. We have taxable benefits and non-taxable benefits for Social Security and Medicare tax purposes. For the most part, almost all of those are the same for federal income tax purposes as well, but not all of them. And a big one that's different is 401k contributions. So 401k contributions can be provided by the employer. They can be paid by the employer. They could be paid by the employee, or what oftentimes happens is it's some combination of the two. Employer pays some, employee pays some. Amounts that the employer provides for 401ks, these are retirement plans, by the way. I'm sorry, I just used that. I throw that out there, assuming everybody knows what it is, and everybody might not know what it is. So a 401k is a type of retirement plan. Employer paid 401k contributions are never taxable to the employee. Those are always going to be non-taxable. The employee paid, so the amounts that the employee is contributing to their 401k for federal income tax purposes are always going to be pre-tax as well. For Social Security and Medicare tax purposes, however, they are not pre-tax. They are post-tax. So when you're doing, and we'll go through some of these problems when we're doing the 941 forms, when we're completing those 941 forms. Remember, there's a line for Social Security, wages that are subject to Social Security and Medicare taxes, or Social Security taxes, wages that are subject to Medicare taxes. And then up at the top, we've also got this other total wages. The amount in the total wages, the box 2, if you can recall, maybe I should pull it up so that. So just to kind of remind you what it looks like here. So this box here, box 2, where it says wages, tips, and other compensation, this is referring to amounts that are taxable for federal income tax purposes. So any of those pre-tax benefits that were subtracted for federal income tax purposes would not be included in that box. Down here are Social Security wages and our Medicare wages and tips. These are the amounts that are then going to be the amount of wages that is taxable for Social Security and Medicare tax purposes. Those two amounts could be different. This could be different from this and this. Okay. When we get to that point, we'll look at some 941s toward the end of the chapter as well, and I'll show you what I'm talking about there and why, in some cases, where that would be different. All right. So, but this, I want you to remember this, okay? Taxable, non-taxable, post-tax, pre-tax, and the difference between, the employer and the employee paid benefits. All right. Let's see here. So this kind of goes through the list of things that are considered to be taxable. You can look through that list yourself, pull it off. I'm not going to go through each and every one of these, but a lot of them you'll notice are the same as those payments that are taxable for Social Security and Medicare tax purposes that we already went through. So things like, the meals and lodging, again, all depends on whether it's for the employee's convenience or the employer's convenience, whether it's going to be taxable to the employee. Again, so here we're talking about employer provided fringe benefits. Like I said, I'm not going to go through that whole list. Again, this is kind of a very shortened, condensed list of items so here's some examples of fringe benefits that would not be taxable. So services provided at no additional cost, employee discounts up to a certain percentage. So like, I think it's up to 20 or 25% of a discount. Beyond that, the employee is actually supposed to pay that's supposed to be considered taxable income to the employee, the fact that they got a discount beyond that amount. Does that happen? I don't know. On-premises athletic facilities. So those, if the employer has a gym on site and the employees can use it, there's no additional, that's not a taxable benefit to the employee. If, however, the employer doesn't have a gym and they're helping to reimburse for gym membership somewhere else, that then makes it a taxable benefit. So the fact that whether or not it's on the employer's premises or off the employer's premises makes a difference as to whether it's taxable or not taxable. Reduced tuition for education. So if you work for a higher education institution or even a, well, I don't know that like private schools, primary and secondary would be included in that. But tuition for higher education. So if you're an employee of a institution of higher education and you get a reduction in your tuition if you're taking classes and stuff like that, that's not taxable. Yeah.
Is a master's degree count on that area?
Master's degree would count as well. Yeah. So any tuition reduction. So like if you work for, I think, I don't know, Drake offers reduced tuition for employees. DMAC does for employees. And for their dependents. So that amount, even though it's a benefit, so it's a benefit because now you're not paying that tuition, right? But it's not taxable to the employee. Working condition fringe, there's a whole, and if you wanted to look, so the Circular E, Employer's Tax Guide, I think, did I post that up here? If I didn't, I will. Get that Circular E up there. There's a whole big long list. We can't go through all of them. So there are a couple different ways to withhold on fringe benefits. The usual way is that it's a amount that gets added over the course of the year. It's just divided up per paycheck. So if you have like a fringe benefit that is taxable and it's worth say it's got a fair market value of $2,400 and you got 24 pays in a year, they add $100 every pay to your paycheck. So that's one way to do it, is to spread it out. Another is to just do it in one lump sum. Employees tend to prefer the spreading it out one, because then it means that they're not paying a bunch of tax on income they didn't actually receive all at once, right? And that's what they talk about here. So the country club membership, if your employer provides a country club membership for you, woo, that'd be awesome, wouldn't it? Definitely a taxable benefit. Okay, you get no tax benefit from that, but you get the country club membership. They can take the full $2,000 value in one paycheck and add it to your taxable wages, or they can spread it out over multiple paychecks. Okay, so a couple of ways that can be done. So tips, yes, tips. And again, so it's $30, right? Did we get that settled? It's $30, not $20. Is it moved to $30? Let's see. I can't even remember what our final, somebody chimed in.
If I remember correctly, in chapter 2, it said $20, but chapter 3 said $30. So that was like
Yep. Let's see. I think it is 20. I think it's still 20. But you're right. At one point it said 20, and at one point it said 30. Which led me to wonder if that had changed. Let's see, monthly, maybe 2023 it's changing. No, $20, it's 20. 20 is correct. Oh, sorry, you guys can't see the screen. All right, so any amounts over 20 are going to be taxable, and then that amount is reported by the 10th of the month to the employer, and then the following paycheck, the employer adds that amount to the employee's wages. It gets added then to the total wages, and then the taxes are calculated based upon that. Okay. In that case, they did receive the cash. They just got it before that paycheck, right? They've already received the tips. They got them the month before. So they just haven't paid the tax on them yet. They haven't had the taxes withheld on them yet. So it's just they're calculated in arrears. Okay. Employer collects the income tax and the Social Security taxes on reported tips. So if the employee reports those tips, the exact amount, then the employer will add that and collect both income taxes and Social Security taxes to that amount. Now, there is a way that employers can do, it's called tip allocation. And instead of actually having the employee tell them how much they earned in tips, it's an assumed amount. It's like 7% of the sales for the month. In that case, they record it and it is taxable to the employee, but the employer does not withhold any taxes on that. So the employer only withholds taxes on tips that are reported by the employee to the employer. Both are still taxable, whether it's allocated or actually reported, the actual amount of the tips. Both of them are taxable. Okay. There are three, I'm not going to go through the three methods, but it can be based on hours worked, gross receipts, or some sort of agreement between the employer and the employee. Okay, I'll let you guys have that. Yeah, Ange, go ahead.
Yeah, teacher, I have a little bit question because I have a confusion for 30 for the tape because in the FICA the tape is 20. Uh, if you move for FLSA, the tape is 30.
Yeah, I think it is 20. I know at one point the book had said 30,
Yeah,
and I think that was a mistake. Because everything I see says 20.
because if you move back
So,
for chapter 2 for FLSA, the tape say 30. After 30 is taxable. I don't know. I don't understand because if you
it's,
put 20, it's not right. If you put 30, it's right sometimes. So I want to make sure what I'm
yeah,
doing right.
I think the 30 is a mistake. I don't think the 30 is accurate. Because when I look up, um, here, hold on just a second. I'm trying to pull it up from the IRS website here. Of course, it's not going to be, we're just. Here we go. Okay, well, this is right from the instructions in the IRS from the form. This is the form. Let me see if I can make this bigger. All right. So the form is pretty simple. They just indicate the amount that has been reported by the employee. Reporting tips to your employer. If you receive tips that total $20 or more for any month while working for one employer, you must report those tips to your employer. IRS says it's $20. I think the $30 is incorrect. So just use $20. Does that make sense? Even though it's apparently the book is wrong, at least in chapter 3. Or this is the actual form. So employees' daily record of tips. They've got spots here for all of the days. Tips received, credit card and tips received. So this is what has to be filled out by the employee and given to the employer by the 10th of the following month. So it's March 21st. Employees will keep this record ideally every day during the month of March, and then by April 10th, they provide this information to the employer, and then on the next payday, after April 10th, the employer is then going to include this amount in their taxable wages and withhold based upon that.
Why is it the 10th?
And just
Just a day.
just a date, a deadline. All right. So yeah, use 20. IRS says 20. Let's see. Travel expenses. Okay. So employers, if an employer has what's called an accountable plan, then any travel expenses that are reimbursed, such as mileage reimbursement, gasoline reimbursement, that sort of thing, other types of reimbursements as well, are not taxable to the employee. Now, what is an accountable plan? Accountable plan is really just a document that the employer keeps on file stating what items they will reimburse and what items they won't reimburse, so that the employee should get a copy of it so that there's an understanding. It's not something that goes to the IRS or anything, but it's just a kind of a contract that is maintained by the employer and kept on their premises. Accountable plans, if you're an employer and you would want an accountable plan, you can look up online, you can Google it, and there are templates for accountable plans that you can have. So employers can reimburse for all sorts of things. They might reimburse you for if you work from home, they could reimburse you for electricity, for the space where you're using the space that you use as your office, for interest that you pay on your mortgage based upon the space that you're using for your office. So because you're using your personal residence for office purposes, employers can reimburse for that. Now, a lot of them don't, but they could. If it was part of an accountable plan, then the employee would not have to pay. That would not be taxable income to them. The most common example of travel expenses, anyway, is mileage reimbursement. So employees who use their personal car for business purposes oftentimes will get reimbursed by the employer for the amount of miles that they put on their car. My husband, every month, he keeps track of he drives all over the place. He keeps track of his miles every month and he submits it to his employer and at the end of the month, and then gets a check for his mileage reimbursement. Now he's paying for all the gas and the maintenance and everything on his personal vehicle, but he gets, based upon the number of miles that he drives, he gets reimbursed for that. And because he drives so much, it actually pays for his truck payment, which is kind of nice. But it's based upon a mileage rate that is set by the IRS. I think right now, and that mileage rate takes into account the cost of gas, the cost of maintenance, and depreciation on the vehicle, all sorts of different factors. Now, because gas has been so highly priced, that rate has gone up in recent years. I think it's over 60 cents a mile now. So think about it. If you drive 1,000 miles during the month, $600 for that mileage then, but it's not taxable. So because there's an accountable plan in place. That's probably the most common method of that we see for those non-taxable. And again, this would be, well, I don't even know that you'd want to really call it a fringe benefit, but I suppose it is. But it would be a non-taxable type of fringe benefit. Now, you're also, the reason I say I don't know that I'd want to call it a fringe benefit is because you're actually paying for your vehicle. You're still paying for all the gas and all of that stuff that goes along with it. If there is no accountable plan, though, then it's supposed to be taxable, those reimbursements. All right, amounts that are exempt from withholding, those are those non-taxable amounts. Your book has a much more detailed list, but these are some of those items that would be included. Deceased person's wages. Those would not be taxable. So you can look at this specific list. All right. Cafeteria plans. So this is, now we're moving back over here to these employee paid benefits. Amounts that are part of a cafeteria plan, this is that section 125 plan, those types of benefits that are associated with health. So health and accident insurance, life insurance, dependent care assistance as well, and health savings accounts would be under that umbrella. So any amounts that the employee pays towards those are considered to be pre-tax as long as they're part of a section 125 plan. Okay. If they're not part of a section 125 plan, a cafeteria plan, then they are supposed to be post-tax benefits. So it's important for employers to have a section 125 plan. And there are companies out there that specialize in putting those together for other companies. Let's see here. Pre-tax salary reductions. So this is where we're talking about these amounts that then reduce the taxable wages. Contributions to cafeteria plans that employees make, contributions to these flexible spending accounts, which I'm not quite, they actually just mentioned up here that, well, I guess they didn't include in here flexible spending accounts. There are certain types of flex spending accounts that are related to health. You can contribute up to, actually now in 2022, it was $2,850. Now it's $3,050 a year. You can contribute to a medical savings account or to, and it will, what happens is it's an amount that is withheld from employees' paychecks. It reduces their taxable wages. It then gets diverted to another account that the employee uses and draws from when they have medical expenses. So, for example, you buy a pair of eyeglasses, you pay for it through that flex spending account. You've earned the money already. It's not taxable. It was never taxable to you, but now you've got access to the funds that you can use to pay for those glasses. If you don't do that, if you don't have a flex spending account, then chances are that the cost of those glasses would then end up being post-tax because you're not going to get any tax benefit from it. So it's a way to get a tax benefit from some of those medical expenses, where you wouldn't have otherwise. Because the rules, the income tax rules with regard to deductible medical expenses are really restrictive. Most people don't get any benefit from it, but this is a way to get a benefit from it at the time of the paycheck. Okay.
That's only provided by the employer.
So yes, you have to do it through an employer. Yeah, only employers can. You can't do that separately, unfortunately. Yeah.
So for the employer, like Roth IRA, is that taxable
So
to employers?
If the employer contributes to the Roth, then the employer is going to get a deduction for their portion of the contribution. If the employee contributes to a Roth, they do not get that reduction at this time, but when they receive the benefits, it's not taxable when they actually receive that. So for the employer, it would, on the employer side, employers' income taxes, yes, that would be deductible for them. The amount that the employee contributes is not reducing their taxable income at this time. So just like if you were just to contribute to a Roth, not through your employer, you don't get any tax deduction for it, but at the time that you withdraw the funds, you don't pay any tax on it. Does that make sense? Does that answer your question? Okay. All right. Questions about these? But yes, it's only through an employer. Mhm.
Also, the Roth IRA, you can do it through yourself or you can do it through the
You
employer?
can, yes, you can do it. You can set up a Roth IRA yourself if you have earned income. Consult your tax advisor. Health savings accounts, that's another type of pre-tax benefit that if an employee contributes to it will reduce their taxable income on their paycheck. Health savings accounts are a little bit different from those flex spending accounts. They're both health related. So health savings accounts, there are higher limits to what you can contribute. We saw the limits, contribution limits for the flex spending accounts. For health savings accounts, they're, well, I guess for individuals, it's about the same on an annual basis, but if you have a family plan, you can contribute up to like about $7,000 into the health savings account. Flex spending accounts don't roll over to the next year. You use it or lose it. So you have to spend all the money that's in it. Otherwise, it will be taken back. Now you have like you can roll over like $500 of it, and you have like 3 months to use up what you have to use up. So they go into March.
Is that your money or that's something that you earned with like interest and stuff?
So the flex spending accounts do not earn interest.
Okay.
The flex spending accounts expire. They have, they don't roll over. You can only use them for medical expenses. And they have lower limits as far as what you can contribute. The health savings accounts have higher limits as far as what you can contribute. They do not expire. They roll over. That's your money always and forever. Even if you don't work at that employer anymore, you get to keep that money, any money that you have in that health savings account. In fact, what a lot of people do is they'll contribute to a health savings account as a way of saving for retirement, because they will then roll over. They'll just keep contributing to the health savings accounts. Maybe they're not eligible to contribute to an IRA because of their income levels. So they contribute to a health savings account, and then just before they can do a one-time rollover of that health savings account fund into an IRA, a retirement account. It's kind of a way, there's several wealthier clients that I had that would do that regularly because they made too much money to contribute to IRAs because there are income limits on it. But it helped them to then save additional amounts in their retirement accounts. Also, the health savings accounts they can earn interest. You can invest the amounts in securities, stocks, bonds, different types of investments. So you have the opportunity to use it as an investment vehicle as well. Now, the downside of the health savings account is that you have to have a particular type of health insurance in order to contribute to a health savings account. You have to have what's called a high deductible health plan. High deductible health plan is, it is what it says it is. It's a plan with a high deductible, but it is a specific type of plan that it works in conjunction with the health savings accounts. The whole idea behind it is you have a high deductible health plan, which means you're going to have to pay the first, whatever the deductible amount is. If it's $5,000 a year, you're going to have to pay the first $5,000 of medical expenses before the health insurance kicks in. But the idea is that you've got that money because you contributed to a health savings account and you got that $5,000 in there. Now, if you don't use the $5,000 toward your health during that year, then it just stays there and it keeps accumulating and keeps growing as long as you contribute to it. But you have to have a high deductible health plan in order to contribute to a health savings account. So that's a big limitation. So not everybody can contribute because of that limitation. So if you just have regular old health insurance you can't contribute to a health savings account. Now, if you used to have a high deductible health plan and you contributed to a health savings account and you still have funds in there, but now you don't have a high deductible health plan anymore, you can still withdraw funds from that health savings account to pay for medical expenses. You just can't contribute anymore to it. Okay.
So you say you can withdraw or roll over in case that you want it added to another IRA or?
So I think the rules at least used to be that you could only do it once, like you could only roll it over once. So, you know, people would wait years and years and just accumulate it and then roll it over at one time into an IRA, another IRA. But yeah, it just rolls, it's yours. You own it. You own all the money in there. And the employer can contribute to it up to that total limit. So if the employer contributes to your HSA, it is non-taxable. It is a non-taxable benefit. And again, just like the 401k, the retirement accounts, oftentimes the employers it'll be set up so that the employer contributes some and the employee contributes some, so that they kind of share all that. But the overall limit is the same. So you can't like double it up, that the employer puts in all of it and you put in all of it. Okay. I'm not even going to get it. I don't know that the Archer Medical Savings Account, I've never encountered anybody that actually uses one of those. So, retirement contributions, again, we already talked about that. So individual retirement accounts, these are, IRAs are accounts that, well, it's individual. Usually it's not attached to an employer. If it's an employer retirement account, then it's going to be like a 401k or a 403b. And all of these numbers / letters reference the tax code that defines it. Okay, so if you hear 401k, that means it's in section 401k of the Internal Revenue Code. You would find it, that the description under that. So I'm not really sure why they go into the IRAs so much, because IRAs for the most part aren't going to affect payroll, because like I said, they're done mainly through individuals. Individuals will contribute to them. Same with the Roths. Now there are such things as the Roth 401ks now that employers will then contribute to as well. Okay, so that's kind of all of that background until we get to this. Questions about that stuff? We're going to do some calculations here. Anybody out there? And don't let me forget I got to take attendance too. Let me stop and take attendance real quick before I forget. Hold on. Okay, cool. I do not want to forget. All good, excellent. It's all good, man. Okay. No Alex. Elma. Lisa. Yummy. Ben. Daniel. Kylan. Kenya. Okay, cool. Thank you. I don't want to forget to do that. Yeah, Julia, go ahead.
Would work if I had my mic on. So I have a question. I apologize if this was already answered or not. So you were talking about when your husband gets paid for the miles that he travels. Does that count as being employed, like self-employed? and you would have a different tax bracket that you would be in?
No, so in his case, he is not self-employed. For a self-employed individual, what they would do if they travel a lot, they would track their own mileage and then they would get a deduction from their taxes based upon that mileage, but the same rate is being used. So like I said, I think it's like 62 cents a mile or something like that. So if you're self-employed, you don't really get the cash, but you get a tax deduction for it. But if you're an employee, you can get reimbursed for it, and that is not considered income to you. Does that answer your question?
Yes. So, in cases like if there was a Uber driver, let's say, and they're getting paid by the mile to deliver something that's more like they're moving across state and they're getting paid by the mileage. Uber is
Right.
considered more of a independent contractor, so you can work for yourself. So how does that work?
So then that Uber driver would keep track of all of the miles that they drive for Uber. So if you're picking up a customer and you are taking them 100 miles from the pickup point to where you're dropping them off is 100 miles. And let's just say you get paid $1 a mile. So you're getting $100 for that trip. Well, that 100 miles, you would also multiply that 100 by the federal reimbursement rate, which, like I said, is maybe 62 cents a mile, something like that. So you would get a deduction of 62 cents off of that $100. So the actual taxable amount of your income would be $38, not the $100. But it's done on your individual tax return. Yeah, Lisa.
Okay, if you drive 100 miles out of town, that means you've got to come back. So you don't get paid to come back? That doesn't count part of the...
Well, that's considered commuting miles.
Wow.
So yeah, so when you drive from your home to where you're picking the person up, that's considered commuting. You're commuting to your workplace, but then when you've got your passenger, where you're taking them, those are work miles. But then when you're going home, that's commuting once again.
Okay, thank you.
Yep. Yeah, that's why I think a lot of Uber drivers don't like to do those long distance trips. Julie, did that answer your question?
Yes, it did. Thank you so much.
All right. So let's get back to doing this here. Okay, so we've got kind of all of this straight as far as employer provided benefits, employee paid benefits, taxable, non-taxable, post-tax, pre-tax. All of this stuff figures into the calculation that we do for withholding. Okay, so if there's an item that is taxable, we're going to add that to our wages, and then we're going to base the withholding on the total amount, the taxable benefit and the wages. If we've got a benefit that we're paying that's pre-tax, that's going to reduce our taxable income, right? Before we calculate what our withholding amount is. So that calculation that I went through before we left for spring break, I had assumed that we had already gotten to this point in my calculation, but we have to get to this point, okay? So we have to do this whole part as well. When I did it, I based it on what was already taxable. Okay. All right, so there are, let me see here. This is so hard to do when it's so tiny. All right, so we looked at that W-4 form as well. I'm going to pull it up again. And remember, I said we've got pre, let's look at 2022. Just so we don't get confused. I don't know if they changed anything in 2023. Come on. Okay, everybody remember this? We looked at how this is filled out. Whoops. Name, all that, the filing status. Remember we went through those filing statuses, the possibilities here. There are 5 different possibilities. And then this checkbox as well. Remember, if there are 2 jobs, whether it's a single person with 2 jobs or you're married and both of you work, if the wages are approximately equal, then you check this box and it helps to confirm, or it helps with the calculation. It helps get a more accurate calculation on withholding. I don't know if you recall when we were looking at the tables, and we'll look at them again, there were different amounts for whether you checked the box or didn't check the box. If you didn't check the box, that was standard withholding and you had lower withholding amount. If you did check the box, then it was a higher withholding amount, that checkbox withholding. So, let's see. Remember, we have 4 pieces of information that we need in order to calculate withholding. Does anybody remember what they are? I just said 1, checkbox. Is the box checked? Is not checked, right? So checkbox. We'll put that down at number 4. What else do we need to know?
Single or married?
So filing status, right? When we talk about the old way of doing it, yes, it's going to be single or married. You're not going to have this filing status issue. It's, are you married? Are you not married? And that was it. But now we need filing status. So I'm going to put that as number 3 too. What else do we need to know?
Taxable wages.
Taxable wages, right? These wages here. What's the last thing that we need to know?
How many dependents?
Nope. We don't, that, when we talk about the old way, we're going to talk about that. Those are the withholding allowances, which you can see on here. I don't know why they haven't changed this. They still use that terminology. They shouldn't have that up there. That's the new way, doesn't even use that terminology anymore. What's the last?
The last one, there's frequency of payments,
That's right, frequency of pay.
weekly, bi-weekly.
Right, how often are we paid? So those are the 4 pieces of information that we need to know in order to calculate withholding. Now, what we went through with all this stuff, I was discussing just how to get to this point here, right? So how to arrive at these taxable wages. Then in addition to that, once we've got that, we also have to know how often are we paid, what's the filing status, and the filing status is indicated on the W-4 form, right here, indicated by the employee. They make that decision, not you guys. And then we also need to know whether or not this box was checked. Okay. Once we have all of that information, we can calculate the withholding. Now, there are a couple of additional factors because this W-4 here has other lines, right? If there are dependents under the age of 17 or other dependents, and again, these are determined by the employee. You don't have to, you don't help them decide whether or not their dependents qualify for this. That's something they have to fill out on their own. But if they have indicated any amounts here, this will also factor into our calculation. And I think we do have some problems. So I'll go through some of the problems with you guys that do include this information. This is for the child tax credit and for the credit for other dependents, which show up on the income tax form. Okay, so that's what this is pertaining to. This is actually, when we do it, when it's included, it's actually a pretty easy calculation. But it does factor into our calculation of withholding. Also, we're not really going to get into these. I don't think you have any problems that deal with amounts that are in line 4, any of these boxes for line 4. But these would be amounts that, again, filled out by the employee, right? If they have some other type of income that they want where there's not withholding, but they want this paycheck, through this paycheck, they want to pay those taxes, they can do that. So they've got, let's say they get, I don't know, $10,000 a year in interest income. And they know they get it every year, but there's no income tax withholding on it. But when they file their taxes, they have to pay tax on it. They can have withholding through their W-2 job to pay for those taxes as well. And it would be indicated here. So they would indicate that they've got this additional $10,000 of income that they want included in the calculation, okay? Or if they expect to itemize their deductions. I'm not gonna get into the difference between itemized and standard deductions, but you can, when you take income tax accounting, we'll get into it then. If they do, then they would have filled out, and there are worksheets, at least there's an additional worksheet for this one that would help them to determine that calculation. Or if they just want an extra amount withheld, let's just say they've filled this out, and just to be on the safe side, they want an extra $50 every paycheck taken out because they might get some extra income along the way, but they're not quite sure. But they want to make sure they've paid in enough, or maybe they really like getting a refund, and they want to have. This is a way that they save money. They can just put an additional amount in there, $50, $30, $120, whatever. And then ultimately that amount, once we've calculated how much withholding there is, that gets added to it, okay? Once we've used that table and everything to calculate the proper withholding, then that extra amount gets added to it. Again, it's the employee that decides this stuff, yeah.
So for step 4A, do you have to put the number in there?
No.
You don't have to.
No, there's no requirement. It's completely voluntary. Yep.
And then for the dependents,
Mhm.
is it like mom or dad or the kids that are aged 18 and above?
So this is for if they are under age 17, you would indicate, so it says multiply the number of qualifying children under age 17 by $2,000. If you're going to take the child tax credit. So if you've got 2 kids, one of them's 15 and one of them's 14, you'd have 2 times 2,000, you'd put 4,000 there. If you have a kid who's in college, they wouldn't, and they're like 19 years old. They're in college full time. They're still your dependent. They would qualify for this $500 credit for other dependents. So you'd have, maybe you got 2 kids that are under 17 and one that's in college. So you've got 4,000 up here, 5,000 or 500 here, 4,500 would be the total here. That's going to figure into the calculation. Everything here, entered here, is going to reduce the amount of withholding. Everything entered here is going to increase the amount of withholding. Okay? Those things do figure in for the most part, most of our problems. This is all we have to worry about, is what's in this step here, steps 1 and 2. Step 3 does factor in, I think, maybe to a little bit a couple of your homework problems. Okay. So again, so these two things come from the W-4. Our taxable wages, we're going to use our calculation to figure out how much, when we take into account our fringe benefits, our taxable fringe benefits, and any of our pre-tax deductions, that's going to get that. Then we're going to arrive at our taxable income. That's going to be how we get this. And then our frequency of pay, your problem, you're going to know that, right? That's going to be in your problem. Read carefully though, because I have noticed some of the questions that I get from students are just that they had the wrong frequency of pay, or they didn't realize what the frequency of pay was, or, you know, that was one of those little mistakes like that. Let's see here. So that, I don't need that. I don't need that. Where'd it go? Okay, so don't pay attention to that withholding allowances. Don't scratch that. We will talk about that when we talk about the information in the appendix, the old method of calculating withholding, which again, remember, we have to know that because that method is still in existence. There are still employees out there that have those old W-4 forms. All right, so here's I already was just talking about all of this stuff here. Let me see here. Okay, I've got one more slide here, and I'm going to get to that question. That there is a homework question out there. Other income sources. Oh, wait, no, we already did this. Oh, no, we didn't. Sorry, this isn't the part on the other W-4. So this is just kind of an FYI. Different sources of income can have withholding. Just because they don't have withholding doesn't mean they can't. If Social Security income can have withholding, interest income can have withholding, dividend income, all that stuff can have withholding. Retirement income, pensions, that kind of thing, they have different W-4s essentially. So, and you'll see it just has another letter at this. So if it's for pension income, it would be, the recipient would fill out a W-4P. Third-party sick pay, so this is where like long-term or short-term disability, that sort of thing. There's withholding on that because that's taxable income. W-4S, government payments, so Social Security benefits have a W-4V. So that's just kind of an FYI, that it's not just wages that can have withholding. Other types of income can also have withholding, but we're concerned with the wages. Okay. Questions before I get to this other question? We're going to go through those. Okay, so what was the question, the homework question that you had? What number was it? Yes, please proceed.
Yes.
43.
43? Okay.
Yeah.
All right. 43, chapter 4, number 43. Okay, so Yep.
Yeah, just number 3.
You see
Yeah,
this one here? Okay. Okay, what would his weekly take home be if he contributes the maximum allowed retirement contributions, married filing jointly, wage bracket method, and a 2.3% state income tax on total wages? All right. So, and there's the wage bracket method. I got to read the rest of the question here, though. George Clausen, employed by Klein Company, paid an annual salary $42,640, has just decided to join the company's simple retirement account and has a few questions. So what is the maximum he can contribute? What would be
14.
the company's contribution? All right, what would be his weekly take-home pay if he contributes the maximum allowed retirement contribution? So what we have to figure out here is, so we've got it, you've already calculated his contribution to the retirement fund, right?
It's 14.
This was how much?
14. 14,000.
Oh, okay, but that's not how much he's going to. He's going to contribute 2.3%. No.
So
Oh, he is
1279.
contributing the maximum. Sorry, he is contributing the maximum. All right, so go ahead. Sorry.
1279.2.
1279.2.
So 3% for 42,000.
Let's see, what would be his weekly take home if he contributes the maximum allowed retirement contribution? So we know his salary is 42,640, right?
Yeah.
So this is his gross salary. And then he's going to contribute 14,000. This is a pre-tax deduction. And you can do that. Does it say how often? Oh, this is on an annual basis, it looks like. No, his weekly take home. Okay. So there we go. His weekly take home. So there's the
820.
820?
Yeah.
Okay. So 28,640 divided by 52 pays, right?
Yeah.
And there are a couple different ways you could arrive at that, by the way. So 28,640 divided by 52, 550.77. Did I get that right? For his. All right, so his taxable pay, we have to figure out how much Social Security tax, how much Medicare tax, right? And how much state income tax. Now, a simple plan is one of those retirement plans that is not pre-tax for Social Security and Medicare tax purposes. So we're gonna have to do two separate calculations with regard to what's taxable.
Okay.
So for federal income tax, we can use this 550.77.
Okay.
But for Social Security and Medicare tax, we have to use this amount, this 42,640. So 42,640 divided by 52 per pay.
820.
This one is 820. So this is the amount that's taxable for Social Security and Medicare tax purposes.
Okay.
This is the amount that's taxable for federal income tax, federal and state income tax purposes. Uh, Okay. So now we've got to figure out, now we do the calculation. So we start out with the $820, right?
Yeah.
This is his gross. And we're going to figure out, so Social Security, Medicare, so 6.2%. 5084. Medicare, 1189. So here we're just calculating the taxes, all of the deductions, okay?
Yeah.
So these are the amounts that we're going to subtract from this 820 to get at what he owes. So Social Security and Medicare tax, we're going to use the 550.77 to figure out. Now we have to use the tables for the 550.77. So he is. Is he? What's his?
It says it in the.
Yeah. So it's
Oh,
back.
I'm sorry.
Yeah. And the married feeling
Marriage
joint.
with, sorry. Gotcha.
Also, this one is easy to get it.
All right. Oh, that's so tiny. You know what? Use this one. Actually, see this one. All right. So we've got to go to the weekly payroll period. So we got to make sure we're on the right page. So weekly, and it's 550.77. I know that's tiny. And he is married, so it's either going to be the 5 or the 32. I think we're assuming no checkbox. Is that right?
Yeah.
Okay. Standard withholding. Yep. So we're going to use the standard withholding. All right. So if you look up at the top here, standard withholding is the first column.
It's 5.
$5 for federal. State, they said is 2.3%.
Yeah.
All right, so 2.3%, we're going to use the same amount for the federal and state. It could be based on that. So 550.77. $12.67. Okay, so far these are our deductions. We've got to figure out how much is being deducted for the simple plan too. So simple. How would we figure that out? On a per pay basis. So on an annual basis, 14,000 is being deducted. 52 pays, so we're just going to divide it, right? 269.23. All right, so these are all of our deductions. We're going to subtract all of this. Social Security, 84, Medicare, 1189, federal, $5. 8, 67, simple. 259. $470.37. What I get? See if we're right. See if I'm right.
Okay, thank you. I'm just like, I've been getting sick since 1 a.m. this morning, so I haven't had no sleep, like, I just keep getting
Oh,
sick.
what did I miss?
It's just frustrating, and I just feel so weak, my stomach is tight.
Let's see.
I appreciate it.
There's a maximum allowed retirement contribution.
Yeah.
All right, so I'm going to turn your volume down just a bit here.
Like, I'm trying to call my doctors, like, different walking clinics, like, what can I do?
Teacher, I have a little bit something
What's
for
that?
for the last one, because for the last one is seven. You can put on the 706.41 here. The last one, the last question.
Say that again?
Now for the last question, yeah, the result, yeah, here 706.41.
706.41, is that what you got?
Yeah, here, because I want to. It's not go through, so I don't know why. Because
Okay,
everything's go through so this line. So I want to can put this amount here, and then you want to see the
okay.
D is, yeah, D here is 706.41. Yeah, 7, no, 41 is not 21.
Okay, so this is the answer here. Okay, so we can work on getting to there. Okay, so I wonder if this is it rounding? Final answers? 42, 640. By 69, 23. Right.
Juju, I can ask you one question.
Yeah, if you guys have to go, that's fine.
Yeah, because state income statement you take 550.77.
I
So all the time you can take 820 to calculate. So I don't understand. For state income statement, you can take the gross pay to calculate. I don't know if you understand me.
Well, when you're doing, so this one, so the 820, you're going to be using just the 820 for
Yeah,
the weekly pay. So if he did not have any retirement contribution, let's figure this one out
yeah,
first, and we'll go back to this one. So if he did not have any retirement contribution, where's the,
yeah. Only the problem is for retirement.
so 820 would mean that his federal income tax withholding
Yeah, it's 32.
is 32. So 820 state would be 1886. Okay, before that's not gonna change. 1189. Are these the numbers you got? Can you see my numbers?
Yeah.
No, 641, it says it's not correct.
Yeah. So teacher, that's I don't understand because over there for state income statement you take 820. I mean for the
Oh, that
first
one is,
one
yes, so 70641, that one is right. So you don't, what is it? I'm sorry. So so, well, first off, let's see if it's a rounding issue. 6.
When I was looking up one, I think there's one on Ingersoll. There's one.
820 minus 2. Let's try it this way. Minus 2, 69.43. 550.77. That's what we looked at, right?
Well, I've been seeing the kids get out. I don't know if they're that busy though. But what she told me is that blank children pediatrics and Methodist are two different things, pretty much. No doctors from the pediatrics, like children pediatrics, will come over here and help.
so teacher the B answer not include the C
No,
because
because the company's contribution would not
okay.
factor in to his take-home pay. Let's see here. One sec. Let me see if I can see what they're trying to get at here.
Uh, uh,
Which number was that again? 43?
I believe so. I don't know. I have to hear it check every single one, especially in college. None of them. But I mean, hey, everybody's different.
Oh, okay. So here's the solution.
Oh,
They are
yeah.
assuming that the state income tax is not reduced by the retirement contribution, which is not correct. Unless the problem said somewhere that it was not. His retirement contribution would also reduce his state income tax.
Oh, okay.
It
Yeah.
would, this should be 550.77 that it's based on. It should
Okay.
not be 820. Unless I missed somewhere that the problem said, oh, probably this, 2.3% income tax on total wages. That's
Oh,
right.
yeah.
But even when I see that, I'm not gonna think, oh, that's, because
It doesn't make sense.
it doesn't make any sense, exactly, that, it wouldn't be like that. I don't know a state that would not exempt that from taxation, that wouldn't treat it as non-taxable. Or pre-tax.
So, teacher, why you want to do right now? Because
What?
on the with on the math you want to take it because it's not right. It's about to take a 550.77.
Yeah, let me see if I don't know if I can change it. Or
Yeah.
assignments. I don't know if I have any control over that though,
Oh,
because this is not, I mean, it's their program. Let me see.
Thank you.
You're welcome.
yeah. Thank you so much, teacher.
Yeah,
Oh,
you're welcome.
yeah.
I'm sorry that I'll see if there's any way that I can adjust that. I don't know if there is.
Yeah, because only one question, I make 2 days overtime.
Yeah.
Thank you so much.
Maybe I'll just give that hint to everybody. Was not as what? Sorry. So
You're saying a number C, 550.77 on C?
what they did for that one is see, I have up here that this is the amount that's taxable for state income tax and federal income tax.
Okay.
What they're saying is, no, this is the amount that's taxable only for federal income tax. That for state income tax, we have to base it on the 820, because what they put in the problem was it's based on total wages.
Yeah.
So,
Okay, so what is the answer that should be in letter C, according to them?
well, so it wouldn't be, we can fix this here. So it wouldn't be 1267. So it would be based on the 820 and it's 2.3%.
So you calculate over the,
1886.
yeah.
Whatever that is. $18. So this is the calculation that they want. But yeah, that's a little frustrating because in reality, that's not how it works. Even though, yes, the problem says that. So I jumped ahead. I didn't realize, I didn't read carefully, but I think even if I'd read carefully, I wouldn't wouldn't have.
Yeah, because yeah. Thank you, sir. Yeah.
Yeah. So if you come across more like that, that you're like this, I know I'm doing it right, let me know, okay?
Thank, thank you, sir. Yeah. Have
Yeah,
a
you're
good day.
welcome. I'll
Yeah.
see if I can change anything on that, but I may just have to send out that information to everybody individually.
Okay. Thank you, sir.
You bet. All right. So I'm gonna log out of here. If anybody wants my office hours, it's gonna take me about 15 minutes to get over to my office. So, but I'll log into that when I get there. All right.
Okay. Okay, stop recording.
Yeah.